exactly how safe is the money you have sitting in the bank right now? Because with all the different levels of risk that come along with investing, we've always been told that the bank is one place we could park our money and never have to worry about any risk or any loss of our principal. And we pretty much accept the fact that the bank is going to give us very little, if not no interest on the money at all, because we knew in exchange when we woke up every morning and checked our account balances, we would never see a loss. So the organization that protects our money is the FDIC. And until recently, not many people cared or even thought about who the FDIC is and what they actually do. So if you're one of those people that have questions and need answers, you're in the right place. Today, I'm going to be going over exactly that. So make sure to stick around to the end of this video because the understanding of this topic is extremely important. So what is FDIC? The Federal Deposit Insurance Corporation, or FDIC, is an independent agency created by the Congress to maintain stability and public confidence in the nation's financial system. They were actually created in 1933 in response to the thousands of banks that collapsed back in the 1920s and the 1930s. And their primary duty is to ensure U.S. bank deposits in case they fail. So it's important to note that they actually insure the customers and not the actual bank. They also don't protect any deposits held in credit unions. Instead, credit unions are insured by the National Credit Union Association. And in addition to providing insurance protection on your money, the FDIC also supervises banks across the country to make sure they're operating soundly and to make sure they comply with the consumer protection laws. So their overall goal is to protect you as the customer. So how do they work? So when you have a deposit account at an FDIC-backed bank, your deposits are covered up to at least $250,000 per depositor per insured bank for each account ownership category. And the FDIC insurance is not something you need to sign up for. If your funds are held at an FDIC-backed bank, you're automatically covered up to $250,000. So here's a list of different account types that are covered by the FDIC. So the type of accounts covered are your checking accounts, your negotiable order of withdrawal accounts, savings accounts are covered, money market accounts, certificates of deposits, also known as CDs, are covered, and also checks and money orders. So you can definitely screenshot this list just to be on the safe side. So if you have one of those accounts, you're automatically covered just as long as the bank is. But it's also important to know that all accounts offered by the bank are not covered by the FDIC. So here's a list of those accounts. So things that are not covered are stocks, bonds, mutual funds, life insurance policies, annuities, municipal securities, anything you hold in a safe deposit box, and also U.S. Treasury bonds or any notes. So you probably want to screenshot this list too because it's equally as important. However, even though those accounts are not covered by the FDIC, just like credit unions, some of them have their own protection companies that they fall underneath. And I'm sure the banks will definitely be able to give you that information as well. So to find out if your financial institution is covered by the FDIC, you can either ask the bank representative, actually look for the FDIC sign somewhere at the bank. Sometimes you'll find it posted in the window. Or you can also check their website. Just be on the safe side and not assume that they're FDIC insured. You want to make sure they are. Currently, the FDIC is actually responsible for insuring trillions of dollars of bank deposits amongst the entire United States. And that's trillion with a T. And since they're an independent agency, they don't receive any funding at all from Congress. They actually receive their funding by the premium that the banks pay in order to have that deposit insurance coverage. So it's like any other type of insurance coverage, except for the bank is the one that actually pays for it. So you have all the different banks paying premiums to the FDIC, and if one of those banks goes out of business, the FDIC uses all that money to cover the depositors. And if a bank does fail, the FDIC will automatically jump in and pay insurance to all the eligible account holders. So you'll never have to worry about filing a claim or anything like that. And this whole process happens automatically, meaning there's no action needed on your side at all. And I'm sure knowing this isn't going to stop you from worrying or doing anything if your bank did fail. But just know that under federal law, the FDIC is required to make those payments as soon as possible. And that's usually within 2 business days of the bank's closure. So that means if your bank goes out of business on a Friday, you will have to wait a couple extra days. So what actually happens during that process is your bank account is actually moved to an FDIC bank. And when it gets there, they'll give you a brand new account. And your new account will have the exact same balance as your old account had when that bank failed. In alternative scenarios, they just cut you a check for the amount you had covered under the previous bank when it failed. So either way, you're going to get at least $250,000 of your money. However, if there's an event where multiple banks all collapse within a short window of time, the government will definitely need to step in because the FDIC may not have enough funds to cover all those banks at once. Because remember, they're insuring trillions of dollars right now. And unfortunately, they don't have trillions of dollars on hand. Another thing to know is that the FDIC only covers your money in the event of the bank failing. So if you're the victim of any theft or any fraud, unfortunately that is not covered under FDIC protection. So definitely always be careful when it comes to fraud. So overall, when it comes to FDIC insurance, there's not much you need to do on your part in the event of a bank closure. Mainly just make sure your financial institution is FDIC insured and that you have $250,000 or less inside of individual accounts, which means you may need to have several accounts with multiple financial institutions. Just make sure your money is always protected. So I hope this video helped with your understanding of what the FDIC is. And if it did, make sure you hit the like button, subscribe to the channel for more content, and I will see you in the next video.